Good morning, and today is Saturday, the 3rd of February, and this is another episode of Two Grey Beards. We've had a very exciting week, haven't we, Andy? Lots has happened, but net, at the end of the day, probably not a lot of change, but we do have some ideas about how things are going to develop from here.
We had important data that we highlighted for you, in particular the quarterly refunding announcement, but we also had the FOMC, and then we had a slew of earnings. So let's break that down. So, firstly, with the QRA, the total amount of bond issuance was a surprise to the upside, in that about $517 billion of net coupons will be issued in Q2, which was mid-range to the hot to the in my estimate, which was higher than most. So I consider that fine and consistent with my estimate and consistent with a headwind on asset prices broadly. In addition, I think this is an important piece that the FOMC, and I suspect the what we see further from both Fed speakers and later FOMC actions, is a negative $317 billion of bills issuance was planned for Q2, which should take significant pressure off the Fed to slow quantitative tightening. Many forecasters had taken the minutes from the last FOMC meeting and projected quantitative tightening ending as early as June, starting with a taper in March. And that's pretty much off the table. And so I look at that as, again, consistent, not with a slam dunk assets or a sale like it was in July, nor a slam dunk assets are a buy, but leaning as a headwind that should blow for the next 3 months or so. They did issue a they didn't increase the number of coupon of 30-year and 20-year bonds, which was a modest marginal difference versus my expectations. About $12 billion of total supply was not increased, which may take some of the pressure off the long end, but they pounded the belly, which seems to be where most of, including ourselves, are invested because, and this is the next point, because there's a expectation that the Fed is going to cut more rapidly than their dot plot. So, that's what happened in the QRA. Big news, lower significant coupon increase, no quantitative tightening taper needed. Small news, modest favoring of the belly of the curve for that increase relative to the long end. Nick, what do you think the FOMC did?
The FOMC didn't do very much as expected, but what we did have from Jay Powell was basically a parroting of what Wallace said at the Brookings Institute. And let's remind ourselves of what he did say. He basically said that in order to vote for rate cuts, he would want to see two things. One, the revisions to CPI for 2023, which happens this Friday. And secondly, a couple of prints of inflation in 2024, which will start the week after next. And I think for the time being, the March cuts are completely off the table. And we do have the danger that they will change the next set of dot plots if we have some prints which negate the benign inflation picture that we've had for the last 6 months, i.e., higher revisions for 2023, which come out of this Friday, and a hot CPI number on the 13th, which is the week after. So at the moment, we are in a dangerous, precarious position of the market being priced for perfection, and it might not get perfection. That is the danger that we're running at the moment, but it's only a danger as opposed to a fact. What do you think about that, Andy?
Yeah, so I agree completely. Pushback on the how couldn't have been more clear and couldn't have been more, it took, he was not effective initially, but ultimately was proven out by the jobs report on Friday. He couldn't have been more clear. He was saying that the cut in March, which was expected by markets, is not likely in his eyes. And that was the principal pushback, as well as deflecting QT tapering modestly. So I think that was about right. And now we're going to look to this future dot plot, and come early March, we're going to be talking to you about the potential for the dot plot to change. And the dot plot is the Fed's expectation for inflation. And I think most importantly, the dot plot will reflect they haven't cut in March, because I do believe that's off the table unless data goes crazy. And so you have 9 months left with a dot plot through 2024. And currently, 130 basis points of cuts are priced into the 2024 dot plot. So clearly, that will converge to what actually happens. And you'll only have 6 meetings left, with currently about 5 cuts priced in. As we approach March, we're going to be paying attention to the data. And the first thing that both Waller and now Powell have highlighted is the CPI revisions on Friday. So that's what both Nick and I are looking at very carefully. And if they revise hotter, there's going to be a reaction in markets. And if they don't revise hotter, it's still going to take a couple of CPI prints before the dot plots change or stay the same. And when you look at that and say, okay, what could the new dot plot look like? Basically, I think Nick and I agree that absent any significant weakening in the economy, and in particular inflation, 75 is going to be the most cuts that they put in the dot plot. On the other hand, if the CPI revisions are hot, meaning last year's inflation was higher than what had printed, they're going to start taking out some of those cuts. And that could be, Nick and I estimate that could be, there's a potential for the dot plot to have less than 50 cuts, not 25, but something rounding to less than 50. And the market's not prepared for that. Now, when we talk about the market, we're really talking about the very short end of the US Treasury curve. And any change in the dot plot is going to get diffused as it goes farther out the curve, and also diffused as it hits other asset prices. But for now, it's an important tell. And so that's really where our focus is for this week.
What we have to think about actually is the risk reward. I think the risk is of hot revisions and a hot CPI for January, released on the 13th, while if that were to happen, then you would have a 20-25 basis point reaction in the short end almost immediately. On the other hand, if the revisions are benign, i.e., they confirm the current state of inflation, and if the CPI print is in line, then what are you going to get? You're going to get a very modest improvement. So the risk reward is one of danger at the moment, of danger of 20 to 30 basis points worse at the very short end, and probably not less than 15 to 20 basis points at the long end, which would impact all asset values. So that is the danger. The risk reward says be cautious over the course of the next 2 weeks. And if you get the data that corresponds to one view or another, then act accordingly.
Yeah. And so I think it's important for us to mention what else happened this week, which was earnings, and earnings of big tech by and large. And the earnings reaction on Tuesday to Apple and Google and AMD was also at that day, was poor. The earnings were great. The printed earnings beat. The expectations were fairly solid for the guidance was fairly solid for the coming quarters, but markets sold off. And then Meta just blew the doors off in terms of the quality of its earnings. It's always been a relatively cheap stock because people had, I guess, reasonable concern, but bad judgment at the bottom when the management, Mark Zuckerberg, was trying to build the metaverse and change the name of the company, and the spending was a big concern. But the earnings have just been super solid, and the stock went up 22%. That is the most increase in a single name in market capitalization in one day in history. That really dominated Friday's actions, and we didn't close at all-time highs. We made all-time highs and then sold off. And it was principally driven by Meta, and at some late in a sort of secondary effect, Nvidia. And what I noticed, if you own index options like we do, we benefited from that move. But last year was the year of Mag 7. Tesla obviously has fallen out of that august company. Maybe AMD has come back in. But if you look at what drove the index, it's become even more narrow than in the past. Russell's down for the year. On Friday, we had a 1% increase in the index, with the most stocks in history in that index down. So you look at all history and say 1% up, how many stocks down? And this was the most in history. So it's interesting how narrow the rally has been, and we can't trade one stock. For one, we don't know much about it, and two, the index is so heavily weighted to these things. So when we talk about caution, you have to just look at the broader stock market to say, do you buy Meta here? It's been a great investment. Do you buy Nvidia here? It's been a great investment. But unfortunately, it also really dominates the returns of the broader market. So I mention that because I think it makes sense for us to be disciplined in what we do and look at our equity allocation after we did what is essentially a levering up stock replacement. What do you think we should do?
I think that we should basically return to the stock allocation that we had before all this. All we have achieved really is, which is good, is that we bought optionality over the QRA and over the FOMC, and in fact, it costs us nothing because our performance has been exactly the same had we not done anything at all. But what we have done is reduce the volatility of returns and bought optionality. Having achieved that, I think it's probably prudent to return to the allocation that we had before. I think it's very telling that the majority of stocks cannot rise. And that is a confirmation that duration supply matters to the broad stock market. As you said, Meta can go up, Nvidia can go up, even Apple can return to where it closed before the earnings after having been down 2-3%. But all that does is pump up the indices, and if those stocks stop going up or even retrace a very small amount, then the indices will come back and come back very hard. And therefore, I think it's very, very wise to return back from something like a 45% allocation to stocks that we have now to something like a 30 to 35% allocation in stocks. Because as I keep on saying, the risk reward over the course of the next 10 days is that inflation is hot, the revisions are hot, and therefore the Fed removes at least one cut from the dot plots that they supply to us in March. If that were the case, you can bet your bottom dollar that equities will be 3, 4, 5, 6% lower. And therefore the risk reward says, don't be a hero right now. You can always increase allocation later on if those fears are unfounded. Return to the previous allocations now, and then after the 9th and after the 13th, if nothing has happened, if we still think that we're going to have 75 basis points of cuts this year, then the market probably is a buy again, but not very much. But the risk reward at the moment definitely says return to where you were.
Sure. Nick, we have auctions and this important inflation revision data. It's not staying up. Are you watching Powell on 60 Minutes?
I will be watching Powell on 60 Minutes. I don't expect him to say anything that he hasn't said during the FOMC presser. And I really don't expect it to be market moving. But I will definitely watch it. And should he say something of great importance, we will naturally send you an email, but don't expect one.
Any other data? The auctions are 3s, 10s, and 30s, which is an interesting test right after the QRA. My expectation is that the big bond sell-off on the NFP number was partly pricing in the auctions, but there's probably a bit more to go ahead of these auctions, and they could break anyway.
Yeah, absolutely. No, I think the auctions will go reasonably well. The market needs to price down another 4 or 5 basis points for that to happen. I think it'll probably happen early part of next week. And then we wait for the revision on the 9th.
Sounds good.
Thank you very much indeed, and speak to you next week. This is just about the current state of play of the portfolio. If we were to say that all these options were exercised in the Dow, the SPY, and the QQQ, we would have roughly 45% allocation to equities. The other thing that we did was decrease VWOB by a quarter. So now we have 466 shares, and currently allocation would be around 45-46% in bonds. I have played around with this figure here in cash to try to balance out. But as I keep on saying down here, please look at the statements to get the exact allocations, and these percentages are just here for our discussions, so I can show you roughly where we are. Now, what do we want to do? And here, let's go to the order entry page. We want to sell the 3 calls that we have in SPY, QQQ, and the Dow, and buy instead 70 shares of SPY, 80 shares of QQQ, and 90 shares of Dow. That will return us to a 35% allocation in equities. And we also want to sell 100% of SHY, not because we think that is a market risk, but let's return to this page, but because we think at the moment it's dead money which has only risk attached to it as opposed to reward. We would rather have that money in cash so that we are ready to reallocate to either equities or long duration bonds, depending on the outcome of Friday's CPI revisions and also the outcome of the CPI print, which will come out on the 13th. Until then, SHY is unlikely to go up very much, but has the potential, as we explained, to actually come down a lot more than it goes up. And therefore we feel that A, it's not a lot of money, B, it's probably dead money, i.e. the upside is a lot lower than the downside. And we'd much rather have it here in cash, ready to redeploy. So we've achieved what we wanted to achieve, as we said. We have achieved the same kind of performance by buying the options as we would have had we done nothing, and it's time to return to that kind of allocation by selling those calls and buying this amount of shares. If we didn't have just the one option, we would actually be selling at the money calls at the moment. And if you have several of these, selling some calls at the money or even slightly in the money calls would probably be the route that I would take. But since we only have the one share, all we can do is sell them and buy that amount of shares in the respective Dow, SPY, and QQQ instead. It is what it is. It is all we can do. Otherwise, we have the broker statements are all updated and you can have a look at them. The monthly statement for January is also updated, and the monthly performance is as you can see right here. We're up about 1% for the year, and in this period where we think there is a much greater danger of the upside in yields and downside in prices happening over the course of the next 10 days, we think it's prudent to cut back and then reallocate immediately after that danger has passed. Thank you very much indeed.